Hey, this is Joe Pryor. It's my Monday video and it's September 1st, which is the earliest time we can have Labor Day. So as you can see, I'm a little bit more casual than normal. I've been doing a little bit of yard work, not trying to work too hard today, but I thought I would get this video out because we've got a lot of news coming up. Now, last week was a pretty calm week. Although we saw the 10-year Treasury do some improvements that kind of help, a little bit on the mortgage rates. Not a lot, but a little bit. In fact, basically what the market is looking for at this point is the job market, because inflation, that core inflation, which takes out volatility, was still up a little bit. It was at 2.9%, which is way over the 2% that the Fed wants. And so that was one of the reasons they thought, well, maybe so, maybe not, in terms of that 25 basis point cut that, we're expecting from the Fed in the September meeting. Now, the jobs report, which has been poor, and we saw those revisions, and I believe those revisions, both in the private and the public sector, and we're waiting for another jobs report to come out to see if that particular aspect is going to kind of maybe guarantee we're going to get that 25 basis point reduction, because inflation and the job market are two of the big items that the Fed really looks for. But right now, the market has improved. The bond market feels pretty good about things. I think that the jobs are not going to be significant, and if they were, combined with the interest rate, with the inflation rate, then we know that we're going to have a problem getting that 25 basis point cut. Now, let's go back to what the Fed does, and this is the Fed funds rate. This is not mortgage-backed securities, Fed funds rate. So the first order of business, if it goes down 25 basis points, then what it normally is going to do is cut short-term loans. So if you're getting a 3-year car loan, that's going to help you out quite a bit. Now, it can be correlated with mortgage rates because of the 10-year Treasury. The 10-year Treasury is really the benchmark, and it's what in the real estate world we really focus on, because essentially when they do a par rate, in other words, a rate that doesn't have any points, origination, or any extra fees, then they assess what the 10-year Treasury is, because they want to know how they can get their money back in 10 years if they give you a lower interest rate. So they're going to charge you money in order to do that. And so that is where very often the 10-year Treasury really has an effect. So we're watching that very, very carefully. We'll see how it does this coming week. A lot of news is coming out this coming week, and so that's going to be extremely important. Now, that being said, we have big national builders here in Oklahoma City and Tulsa, and what they are doing, and I've mentioned this in videos before, is buying big packages, paying upfront fees to buy big packages of FHA, VA, and Fannie Mae backed loans. And what they're doing is offering the ability for you to get a full percentage point off. So you can take something like a 6.25 rate with a little bit of points, and right now you get 5.125% fixed rate, and that is a 30-year fixed rate. Let me emphasize that. It's not an adjustable rate. We stay away from those. So this is where the market is going. This is what we're going to be looking for next week. I'm going to end it at that. Hope this doesn't interrupt a really good time, that you're having, that you're doing a backyard barbecue or celebrating labor, which is what we ought to be doing this day. So more's coming. We'll see what's happened. I'll give you an update as soon as I know.